Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries to see what is happening on a long time frame. Please follow me on Twitter at Schnell Investor, and you can also find my weekly blogs on ospreystrategic.org as well as StockCharts.com. So the market is working real hard here. We're trying to hold at the June lows. It's been quite a ride down since January, so we're 9 months into this thing, and again, we're testing the bottom of the market range for the year. And the real question is, can we hold here? So one of the concerns I have that's starting to appear, and the bigger issue is if debt becomes a bigger problem, then it's going to put pressure on banks, but it's also going to put pressures on countries. And when pressure on banks shows up, then they stop lending to companies, and then companies can't deal with what's coming at them, so they can't borrow. So then you get into this spiral where as credit gets tighter, then more people get in trouble. So what we're worried about, or what we want to stay up to date on, are things like banks. How are the banks performing? And if they're fine, then we're probably okay. And again, the whole thing behind the '08 crisis was to try and set up strategically or systemically important banks to be stable, and if there was a financial shock, they could absorb it. So we're going to cover off how the market continues to soften. We're making a test of the June lows, and the banks are breaking down, which are a concern to me. And then I really do wonder about the seasonality effect. And again, I've been on this for a little while, but seasonality works really well when everything's in an uptrend and the Fed buys every dip. We're not in that situation where the Fed's buying every dip. So the market has to make one on their own, and the real thing it's trying to do is sort out whether or not the interest rates can top. It looks to me like if the US dollar continues to go higher, and as Europe gets weaker, that's going to push the dollar higher. We have a real problem there. Now we also have another problem on the other side, which is that as the dollar goes higher, it puts pressure on foreign debt in countries. So that also adds an element of trouble. So all of this is creating quite a difficult time environment for us. So will the seasonal low at the end of September, early October hold, and we bounce out of here? And I think you might remember back in 2020, it was closer to the end of the month. It was like October 30th that we started to bounce out of the hole, and then that would have been October 20th or October 30th, 2020. And if you remember, we had the election cycle then heading into November, and then we had the vaccine announcement, and the market went on a big hallelujah rally for about a year and a half. Anyway, from there, what we want to talk about is, are we set up for that? And I think more to the point is, are there clues that we got something bigger going on? And that's what I'd like to share. I am speaking at the ChartCon 2022 presentations, which are at the first weekend in October. So October 6, 7, and 8 in there. In that time frame, what we want to talk about, what we want to watch for is the general presentation across all of these industry experts. I think it should be fabulous to get 17 technicians in at such a timely, important place in the market. And again, why is it important? Well, because we're testing the lows here. If we start to break lower, there's all sorts of price targets much below here. So 3,500, 3,150 for the S&P. Lots of discussion around that. So anyway, what I want to cover off today is the clues that are coming out of the banking, and I think that's going to be helpful. If you like the type of work we do, you could go over to ospreystrategic.org. You can go back and see my newsletters for the last 6 months just to see how good they were or weren't. For $7, you can go in and check all that out. But I was going to say, it does take a while to get a rhythm of the market, and even in bear markets, it's been difficult. But Ron Barron was mentioning that he thought we could be flat for the next 10 years. If we're flat for the next 10 years, then the type of work we do at Osprey Strategic will really help us get into the rallies and stay out for the drops. If you're interested in what we have to offer, again, it's a weekly newsletter, a weekly video, monthly recorded conference call, which we're doing on Thursday, by the way. So if you registered, you'd be able to listen in on Thursday at 5 p.m. Eastern. So hopefully all of that gives you something to think about. And with that, let's get over to the charts. I want to cover off the equities first of all, and I'm going to put up the NASDAQ. Well, actually, we'll use the QQQ and the SPY. And what we want to watch for here, again, big downtrend. We're under the 100-period moving average on all of these 60-minute charts. But as we test this low here, this becomes pretty important. The real question is, can we push higher and start to get going? So some people are talking about the relative strength, and what they're talking about is we made a low down here at 270. We're sitting at 275, whereas the S&P is already lower than the closing lows of there. So we're fighting it out here. I don't think that's enough relative strength to care about. What I do like is the fact that this downtrend in underperformance by the NASDAQ appears to be trying to end. And again, we've got earnings coming up in October, so that might give the market a reason to bounce. We had earnings in July, which gave the market a reason to bounce in there. So it is possible that we do get a nice bounce out of here. Now, really simply, the 200-day moving average was support all the way through. Now it's resistance. And the question comes down to, well, how do you know when we're going to be in our next uptrend? Well, to me, a lot of things have to start to change, but it's this downtrend in momentum that continues, and my newsletter clients will be well aware that this PPO has been rolling over, and that's a problem. Now, what we want to watch for is how does the market deal with the overhead pressure, and can we finally start to make higher lows? So far, we haven't, but we haven't made lower lows yet either. We're still holding above that June time frame. So on the for me, one of the biggest areas to watch for is the banks, and let's get into that right now. To start with, I want to cover off one thing. So the Fed is trying to fight inflation, and you might remember that Paul Volcker back in 1980 said, "I am going to stop inflation." And we had this huge 5-year surge in the US dollar. Now, that wasn't very comfortable, obviously, and then we had this big downtrend that we've had where the US dollar has behaved, and now we've kind of broken above that level. Well, part of this was the Ukraine war, right? That definitely changed it. But the real question is, do we top out at 120 or do we top out back up at 160? And again, are we in this inflation fighting environment like Volcker was in for a long period of time trying to control it? And if so, just look at the whippiness in momentum on the US dollar. At extreme levels, like literally for 4 or 5 years, this thing went up and down in big cycle extremes before it finally topped out. That's the concern we all have, and maybe for people who don't have a history of how price acted during that period, I'm going to put it behind behind price here, and I'm going to make it bright, I don't know, red or something. Okay, so what you see here is I've added a US dollar. I've added the stock market on top of the US dollar. And the goal here is to try and point out that when the Fed started to fight inflation back in 1980, we also had a big spike in the US dollar. When the tech industry was having such a boom back in 95 to 2000, that also put a big lift in the US dollar. And then now we've got the Ukraine crisis, plus we have fighting inflation, and we still have some tech outperformance with the largest 6 tech companies, being up in the trillions. So it's pretty important to just be aware of a macro trend. Now, the one thing I will say is in 1982, once the once people thought the inflation was starting to come under control, we had an extreme stock market rally that went on for a long period of time. We've just had that for 10 years. And now the Fed's in the mode of trying to control inflation. So we're at this crossroad, and what we don't know is, do we have to live through a downturn like this, or can we just get by with kind of what we've already had, which is this pullback so far, and can we start to rally out of the hole? When we, let me go over to the banks now. So what I want to cover off here is I've sorted the banks based on price earnings ratio, and I did this for one reason only, and that is that a lot of people think that the price earnings ratio makes a difference in terms of picking your stocks. And the reason I want to show that to you is we're going to go down this list, and what you're going to find is that some of the stocks are pretty strong, but look at this. This one has a scooter ranking of 90. This one has a scooter ranking of 26, which means the price action on this one is better than 90% of the stocks out there in its peer group, and the price action on this one is only better than 25%. So the price earnings ratio hasn't really mattered in terms of how well the stock performs. And I want to make that really clear because even here, just in the top 10 or 15, you've got this bank with a scooter ranking of 6.5. EPS is 12%. But if we go look at the chart, you know, this isn't really a chart you want to be invested in when it's just literally straight down. Since November, it's dropped from 750 to 350. You're in half, and you know, the chart looks okay. Now, if I compare that with CBOE Holdings, you'll see this chart doesn't look anywhere near as bad, and yet the price earnings ratio might say, well, it looks pretty darn good to me. Well, we can have other charts in here, you know, relative similar price earnings ratios, and they're not anywhere near as healthy. So I think it's important to use price on the charts more than price earnings ratios, and this is one example why. Now, what I'd like to do from here, again, we're sorted on price earnings ratio. I could have sorted on scooter ranking, in other words, best stocks first or best price action first. I did not. And the idea being just to give you a feel for how this changes over time. And this chart, for some reason, save. There we go. Okay, so what I've got here, here's a chart holding up relatively well. It's, you know, it's got a horizontal support and resistance line going on here for a long time, but the PPO is rolling over right at zero. To me, this is a very critical place on the chart, and you can see back here when it rolled over in 2020. This was an issue, but if you try to rally back up into positive territory and can't do that, that's a bigger concern for me. So I'm now going to go look at these charts on a view all basis, and what I want to show here is just as we scroll down, just notice the general shape of the chart. Are we in the top right-hand corner, the bottom right-hand corner, the middle? Where are we relative to, say, 2 years ago? Just to give you some perspective on why I don't think price earnings ratio are a helpful valuation for the stock market. Okay, so here's MSCI, and we're, you know, in line with where we were 2 years ago, but here's the PPO rolling over below zero. This is the second top chart on the list, and yet this thing is failing under the 40-week moving average and looks to me like it wants to go a lot lower. So this is a chart that I would avoid. Equifax, now this one has a scooter ranking of 25, but you can just see it rolled under early in January. It's now rolled over again. It's trying to take out its June lows, and the chart is still healthier than it was back in 2020, but not much. There's not a lot to like here. Here's Moody's, and again, Moody's and Equifax are kind of similar in the business model, but as they start to become more important, as everybody starts to investigate debt and make sure that their clients can pay back the money they've borrowed, these companies might start to perform. But literally, they've been selling off for 8 weeks, so it hasn't really been helpful. The NASDAQ, this is the OMX group, and you can see this chart's actually been above its 40-week moving average, but it's rolling over, and the scooter ranking is up here right in the top right-hand corner. It's been outperforming the S&P 500. It looks very, very good. Now, you can see a big period of outperformance, and then all of a sudden it started to underperform the S&P 500. When these relative strength outperformance areas start to fail, that's a good time for me to really examine whether or not I want to hold the stock. Okay, here's Charles Schwab, and it's rolling over right under zero. It's stuck under the 40-week moving average. Again, this was support all the way up. Now it appears to be resistance, much like I showed it on this QQQ chart. The 40-week is support, and then it becomes resistance. Again, both of these lows were bought by the Fed to create them. So as we continue to roll through here, this chart looks really strong compared to 2020, right? It's way up in the top right-hand corner. It's a much better looking chart. What I don't like is you have a high, a lower high, and now you're making a lower high below zero. This could accelerate lower quite quickly in my book, just the way people aren't interested in the stock. So here's the CME Group. It's now taking out, it's gone below its May low in this case, and then it's also gone below its September low. The chart's broken in my opinion and could go a lot lower. So this is pretty crazy. Now if you compare the CME Group with the NASDAQ one I just showed a little bit farther up, charts are quite different, right? The NASDAQ, I think, had a scooter ranking. Let's just go get it. Had a scooter ranking up in the 90s here, whereas this chart from CME Group, we're only in the high 40s or something. Yeah, 40%. So the chart looks terrible. And again, all of these are just PE ranked, but you can see much different price behavior on the stocks. So HDFC, this chart, kind of where we were just coming out of the COVID lows. It's actually right back to the November, December 2019 period. Not a lot to like. This chart looks like it's rolling over below zero. Again, what is price action done when it keeps rolling over below zero? It stays below the 40-week moving average. Not a lot to like. Here's ICICI Bank, and this one has a price earnings ratio of under 20, but the chart's probably one of the best charts in the entire display, and the reason is because it just made new highs 2 weeks ago and is starting to pull down now. The real question is, is it going to fall like the rest of the bankers? That would be a real question. M&T Bank Corp, I just tried to break out here, but this is held up. I mean, it's been pulling down here, but not like, it's not like the indexes where they've been going kind of straight down. This has had a lot of overlapping price action, but nonetheless, we're still getting a sell signal or close to one on the PPO. But this chart's been, one of the best performing stocks out there. It's up in the top right-hand corner. Relative strength line has been improving for a year. It continues to hold up really well. BlackRock, again, lower highs, lower lows, can't get back above the 40-week moving average. PPO rolling over below zero, and your scooter ranking is less than 50. Again, prices all over the map relative to the price earnings ratio. So I don't think the price earnings ratio helps you pick the right stocks here for better price action. Intercontinental Exchange, like the CME or like the NASDAQ, you're just seeing, lower highs in momentum, and here we are, PPO rolling over below zero. You've actually got a negative number on the PPO versus the signal line, so it's already given us a cross. It's trying to hold at the June lows, but this chart is pretty ugly, and it's had one of the worst scooter rankings since May. Very weak. Raymond James Financial up in the top right-hand corner, holding up really, really well. Basically still in line with where it started the year, which is remarkable. But I would say you've got a lower high system going on the PPO, and you're about to roll over at zero. To me, this chart looks very vulnerable. SVB Financial Group, this chart's been trending lower, nowhere near the top right-hand corner of the chart. And this looks like one of the worst charts we've seen. Prices clearly breaking down. PPO rolling over below zero. There's nothing going on here. The scooter ranking's been terrible since February. Relative strength's been underperforming since the market made its high in November. So this stock has clearly underperformed. National Australia Bank, pretty much sideways, hasn't really cared what's going on in the world. Very interesting, probably a good place to just kind of park money, but it hasn't really made you any money for the risk that you've had to be in the market. DBS Group Holdings, Same thing again here, above where it was a year ago, which is nice compared to everything else. And then the PPO rolling over at zero. This chart looks vulnerable to me. The 40-week moving average was support. Now it appears to be resistance. So we'll see if it can hold up. Northern Trust, this thing's gapping lower here. Taking out the lows. So really a whole change in trend, and I want to make sure that people understand the message that I'm trying to share. One is that the banks are starting to break down, but the second is that when you're looking for price action on stocks, a low PE or a high PE doesn't help. So I've shown you kind of the top stocks. Let's go to the bottom of the list here. And there's a reason. So this chart doesn't look any worse than the ones we've seen, and it's got a very low PE of 6.25, but nothing really making you want to buy it. PPO is rolling over below zero. It seems stranded under the 40-week moving average. It's making new lows, so there's nothing really here. Scooter ranking got weak about a year ago, and it really hasn't been able to outperform. UBS really starting to turn lower here. Again, chart's in line with where it was roughly a year ago to no real gain, but your PPO continues to weaken below zero. The 40-week moving average, which was support, is now resistance. There's nothing to like here. Sumitomo Mitsubishi or Mitsui Financial Group, this chart made a high in March of 2021, kind of when the SPACs topped out. PPO momentum indicator continues to roll down, nothing to like. Société Générale out of France, I believe. The trend line is riding up, and now the 40-week is pointed down. This is stocks just going sideways underneath it after really making a move lower in February, holding up. Now, Lloyd's Financial, this is a big one, starting to break down. Again, the chart never even got back above where it was in 2019, so there's nothing to really like here. BNP Paribas back where we were in 2019. Charts breaking lower, and again, Europe's got a whole bunch of issues facing it with the war next door. Citigroup, this chart topped in June of 2021 and continues to work lower. PPO rolling over. There's nothing really here to like. Now, here's Barclays. This chart's trying to hold on here, but again, we're well below where we were in 2019. And the one chart that I want to make sure I show you is Credit Suisse, which is right at the bottom. And the problem here is this chart is well below the lows of 2020 and looks to me like it wants to really get into deep trouble. Now, if I unwind this chart, okay, its PPO is, or its price earnings ratio is negative. So again, this pointed out one of the weakest charts in the system, but this thing topped in 2013 and has been making a series of lower highs. And now it looks like it's in kind of a death spiral as it just keeps winding lower from 2021 and just really can't get its legs under it. All of that to say, I'm kind of concerned about the banks. They're starting to roll over. So So I don't expect October to be hallelujah, but right now it looks like Halloween, so we'll keep watching. Thank you for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page. Thanks for taking the time to join me. Check out ChartCon. It's going to be great. Thank you. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.